Good afternoon. Welcome to our presentation on what is new and hot in the Luxembourg tax and transfer pricing environment. Together with me is Nicolas Gillet, who is leading our transfer pricing team at EY Luxembourg. I am Daniela Hockelmann, associate partner in our international tax practice. In the next 30 minutes, we'll walk you through a couple of recent developments and trends we are seeing in the Luxembourg tax and TP world, which we think can be of interest for companies performing financing and treasury activities in Luxembourg. We first take a look at some selected aspects of the recently issued OECD report on financial transactions to see what it means for treasury activities. After that, we'll talk about other interesting tax aspects and trends that could impact financing and treasury in Luxembourg. As part of that, we'll look into, in particular, at a draft law limiting the deduction of certain payments made to blacklisted countries and speak about a trend that we are seeing in the field of tax controversy. Let's start with the new OECD report on financial transactions, or Chapter 10, how it is sometimes referred to. And the question, is it a game changer or just business as usual?
Thanks, Daniela. So, as you said, transfer pricing experts have been actually waiting for this paper for quite some time now, as it was debated at OECD level for some years. As you might know, the OECD guidelines describe how intra-group transactions should be priced. OECD guidelines comprise 9 chapters, but no chapter specifically focused on financial transactions. So the point has been resolved now with the release of this new Chapter 10, which is fully dedicated to the pricing of intra-group financial transactions. As Luxembourg has only introduced Chapter 1 to 3 of the OECD guidelines in its legislative framework, we believe that a change in law would be necessary to implement Chapter 10 in its entirety in Luxembourg. As Chapter 10 is the application of Chapter 1 to financial transactions, some of its content might, however, be used by the Luxembourg tax authorities or potentially by a judge either to interpret certain sections of the current Luxembourg law, or it could serve as a guidance for matters that are not currently being dealt with by Luxembourg law, like, for instance, debt-to-equity ratio, or that we'll also cover later on in this presentation. So in particular, Chapter 10 defines whether a financial transaction should be regarded as a loan or not as a loan, and provides a methodology to define the quantum of a debt on one side and the amount of interest to be applied on the debt on the other side. So both components will determine the interest deductible on such a debt. In order to arrive at the amount of interest to be deductible on a given loan, Chapter 10 recommends a two-step approach. So the first step, step 1, that you will see on the left-hand side of the slide, will consist of analyzing the commercial rationale and the terms and conditions of financial instruments used in a financial transaction. The second step, step 2, that you see on the right, will consist of the actual pricing of the transactions. And the OECD probably felt that TP specialists were spending a lot of time on the second step, being the pricing of the transaction, but that the first step was not covered in a lot of details, actually, in transfer pricing studies. So now let's look at the main points of this two-step analysis in a bit more details. Let's start with commercial rationale. We need to ask what would be the behavior of a third party and whether a third party would actually enter into such a financial transaction. So for example, if a borrower has a lot of cash available and has to finance a short-term asset, would the borrower actually enter into a loan transaction? Similarly, if a borrower is in a very bad financial situation, would a lender agree to provide a loan to this borrower?
This aspect is also very relevant if you think about a Luxembourg company that is financed with an interest-free loan. In such cases, it may not be so obvious why actually a third-party lender would grant such a loan. In order to counter potential challenges on the commercial rationale behind such an interest-free loan, our recommendation is to critically assess whether the terms of the loan should be adjusted to reflect a little bit of a more balanced transaction.
Yes, and we also need to ensure that terms and conditions of the financial instruments are at arm's length. So one has to demonstrate that third parties would agree to use similar terms of the financial instruments under similar circumstances.
For instance, if the maturity indicated in a loan agreement should be the one that third parties would be willing to use. In order to finance an asset where the expected cash flows to be generated could be estimated on a 5-year basis, a loan above a 5-year maturity could be difficult in practice to justify.
Yeah, and a third aspect we wanted to also to highlight is that Chapter 10 introduces the concept of options realistically available. So what do we mean by that is when we have both of the lender and the borrower's perspective that should be considered. So for example, a lender might have different options to use his cash, and the fact of granting a loan would not necessarily be the best option for him. On the borrower's side, even if it would have the capacity to borrow additional money, a borrower might choose not to do so in order to avoid placing too much pressure on his solvency or credit rating. So, perspective of the lender and perspective of the borrower have to be considered here.
And the above aspects are not only relevant from a transfer pricing perspective, but there can also be practical implications from a tax perspective, which taxpayers should keep in mind. For instance, in the last few years, there has been case law in Luxembourg which Luxembourg courts have qualified a loan as an informal capital contribution if the normal way of financing would have been a capital increase. In these cases, the courts concluded that the intention of the company was to provide additional equity to the subsidiary rather than to act as a lender. Now, if you look at the criteria which are used by the courts to qualify the loan as informal capital contribution, there may be certain similarities to the indicators given in the OECD report on analyzing other options realistically available. So in summary, I would consider that the new transfer pricing aspects may be used by Luxembourg tax authorities also as an inspiration for the application of already known concepts.
Okay, so another key element is the assessment of the debt-to-equity ratio of the company. We believe that this is a new point to which further attention should be paid. And based on our analysis, the assessment of the debt-to-equity ratio should be applicable to Luxembourg companies which are issuing loan or implementing cash pool arrangements after the issuance of this paper, i.e. after February 2020. The terms of the debt for the investments need also to be aligned to the company's ability to service the debt, right?
Yeah, what's the tax risk if you get it wrong? Well, if the debt-to-equity ratio turns out to be excessive based on the transfer pricing documentation, the interest expense on the excess debt could be requalified into a hidden dividend distribution. And as a consequence of that, the excess interest expense could become non-deductible for the company. And depending on the circumstances, there could also be a withholding tax applied to the hidden dividend amount.
For cash pool arrangements, documentation of the interest rates and the commercial rationale of the cash pool transactions should be performed. Debt-to-capacity analysis depends on the functional profile of the cash pool leader. As we will see later, a cash pool leader performs either coordination or agency functions, so more limited functions, or a role going beyond this coordination or agency functions. In case where the cash pool leader acts more as an in-house bank, and when the cash pool arrangements are implemented after February 2020, an analysis needs also to be performed to estimate the appropriate amount of equity and debt at the level of the cash pool leader. Hence, a justification for the equity amount for entities performing cash pool activities will have to be prepared. This is an important point, an important change to point out. The functions and risks should also influence the debt-to-equity ratio to be applied for the companies. For intragroup financing, so the typical back-to-back transactions that have been put in place in the past where appropriate TP documentation was prepared, we expect a limited impact of the OECD paper on those structures. Particular attention has to be paid to the characteristics of the financial instruments to be used. Such characteristics have to be arm's length, and the appropriateness of the use of such instruments would have to be justifiable in the circumstances. So another point of Chapter 10 is the creditworthiness of the borrower and the determination of the credit rating, which is one of the other factors that independent lenders consider in determining an interest rate. So the guidelines elaborate on how to estimate credit ratings. The OECD guidance specifies that an issue rating represents an opinion about the creditworthiness of an issuer with respect to a specific financial instrument. Conversely, an issuer credit rating is an opinion about the general creditworthiness of an issuer. So when both credit ratings are available, preference should be given to the one using the rating to price on the financial instruments, right, for these given transactions. According to the OECD guidelines, commercial credit rating tools may also differ significantly from the credit rating methodology applied by independent credit rating agencies. So the first criticism made by the OECD is the lack of clarity of certain tools, and because the algorithms and processes underlying the commercial credit rating tools may not be fully transparent, according to OECD. Secondly, commercial credit rating tools often use a limited sample of quantitative data to determine credit ratings. So the OECD guidance then recommends using quantitative data to price the interest rate, but also qualitative data, such as industry-specific features, for instance. Another factor that may impact the credit rating of a borrower is the implicit support from the group. Entities of the group will be more or less likely to receive such support according to their relative importance to the group entity and the linkage between the entity and the rest of the group. So the OECD recognizes that the credit rating of an entity could be enhanced by being part of a group. So this is what we call the halo effect. So now, going to the remuneration of cash pooling structure, so Chapter 10 also provides insights on the pricing of cash pool arrangements. As previously mentioned, the first step would be to accurately analyze the cash pool transactions. So such analysis will depend on the facts and circumstances, but also on the wider context of the conditions of the cash pooling arrangements. The analysis is key. We need to analyze where members of a group maintain debit and credit positions on a long-term basis. The OECD guidelines recommend treating these balances as long-term deposits or loans. And we are aware of recent controversy between German and Dutch tax authorities regarding recharacterization of cash pool balances into long-term loans with corresponding higher interest rates. We therefore stress the importance of having appropriate TP documentation in place supporting the short-term nature of cash pool transactions. In order to price cash pool transactions, the first step is to estimate the remuneration of the cash pool leader by analyzing the facts and circumstances and the functions performed. In general, a cash pool leader performs not more than coordination or agency functions, hence deserve a very small remuneration, typically a cost-plus remuneration. It will receive a higher remuneration if the cash pool leader performs more functions and assumes more risk beyond such coordination or agency role. So, in a second step, once the remuneration of the cash pool leader has been calculated, residual cash pool benefits needs to be allocated to the cash pool participants. Given the current negative interest rate environment, the cash pool benefits could be allocated, for instance, to the cash pool participants depositing in the cash pool by setting, for instance, a 0% floor rate on their intra-group deposits. So overall, as a conclusion of Chapter 10, the introduction of this Chapter 10, in existing structures, so beyond the traditional documentation of the arm's length interest rates and the margins, further attention should be paid to the documentation of the commercial rationale of your financial transactions, including a review of the terms and conditions of the loan or cash pool transactions. For financial transactions entered into after the issuance of Chapter 10, so post-February 2020, particular attention should be paid to the documentation of the debt-to-equity ratio used, i.e. looking at the quantum of the debt and not just the pricing of the interest rate on the loan, in addition to the documentation of the commercial rationale of the financial transactions. In particular, the amount of equity at the level of cash pool leader needs also to be assessed, especially, as I said, when they assume a role going beyond coordination or agency functions, like in-house banks, for instance. So we strongly recommend to Luxembourg taxpayers engaged in intra-group financial transactions to review the compliance of their transactions and related transfer pricing documentation with this new guidance.
Thanks, Nicolas, for the explanation on the new Chapter 10, which is, well, without a doubt, one of the most important tax and transfer pricing evolutions of the year. I wanted to take the opportunity to also speak a few minutes about some other interesting developments and trends in Luxembourg taxation. First topic we wanted to cover is the draft law on the payments to non-cooperative jurisdictions. The draft law was submitted to the Luxembourg Parliament in March this year, and it aims at disallowing, under certain circumstances, the deduction of interest and royalties paid or owed by a Luxembourg company to related corporations that are established in a country that is listed on the EU list of uncooperative taxation, uncooperative countries for tax purposes. The new provisions are expected to apply as from 1st of January 2021, so next year. The EU blacklist is under constant changes, and it currently includes 12 jurisdictions. Among those are the Cayman Islands, Panama, the US Virgin Islands, and the Seychelles, for example. Well, where does this legislative initiative actually come from? What Luxembourg aims at doing with this draft law is that it implements guidance that was given by the EU Code of Conduct Group for Business Taxation. So it's a European initiative. The details of the draft law are more complex. For example, it refers to beneficial owner, and there's also a safe harbor rule in case the transaction is entered into for valid commercial reasons reflecting economic reality. But the important takeaway for Luxembourg companies that receive loans or licenses from somewhat more exotic countries is, first of all, to have this on the radar, and secondly, to keep an eye on the evolution of the EU blacklist and the resulting domestic blacklist, because some countries may be added to it, some may be taken off. Another trend that we wanted to highlight here is an evolution over the last few years actually already towards an increased number of tax disputes with the Luxembourg tax authorities. So what we are seeing is that tax audits and requests for information by the tax authorities are in sharp rise. There's also the trend of tax authorities challenging technical positions is growing. There are more frequent appeals against tax assessments, and the number of tax controversy cases before tax courts is rapidly increasing. Now you may ask the question, why is that? To a certain extent, this is due to the following. EU and international pressure on Luxembourg provoked actually a visible attitude of the tax authorities towards more controls and challenges. Recent developments on the international tax landscape also play a role here. A multiplication of disclosure requirements coupled with, well, more enhanced technology, that's also playing a role, but certainly it's also due to the fact that the number of tax ruling applications in Luxembourg is really in strong decline, and the frequency of meetings and the level of communication with the tax authorities are at a historic low, and that altogether, well, leads to less dialogue and more confrontation. To give you some examples of points of contention we've witnessed so far, the cases include, for example, the non-recognition of foreign permanent establishments, and that also affected foreign finance branches, the cancellation of a fiscal unity, or the non-application of tax rulings, the application of anti-abuse rules, just to name a few. But irrespective of the specific point of contention, it is important for you as treasurers to understand that in many disputes there are substantial amounts at stake, and this may have a considerable impact on the cash and liquidity situation of your company. In such a situation, we think it's very important that you early seek professional advice on how to manage and resolve the dispute in the company's best interest, but also to see how to avoid cash expenses by requesting payment deferrals and installments with no or just at a low interest charged. As a last item, I wanted to mention, before we close, I wanted to mention something on tax compliance. Most taxpayers are currently preparing their 2019 corporate tax returns. And as you may remember from previous presentations, this is the first year, 2019 is the first year where the new interest limitation rules are applied. The forms for the 2019 tax returns have recently been issued, and well, it's no surprise that they also comprise some additional forms that need to be completed to reflect the new rules. As a reminder of one of the technical specifics to it, one important aspect can be to assess to which extent a taxpayer can rely on grandfathering. And this does not only require that a specific debt was already in place before June 2016, but in practice it will entail a whole analysis of potential changes to the amounts or the terms of the debt, which is something we wanted to mention here, since I could imagine that one or the other of you may be asked to assist in this process, which, by the way, needs to be completed, needs to be done before the tax return can be completed. Well, with this reminder on the interest limitation rule, we wanted to close our brief overview on the important tax and transfer pricing developments. Thanks for joining. We hope you liked our selection of the topics. Of course, please don't hesitate to reach out to Nicolas or myself if you need any assistance on the aspects that we have covered.